now. Good afternoon and welcome everybody to the Wednesday Lunchtime Drive-Thru on August 12th, 2020. I am your short order cook, Damon King. I'm a certified financial planner professional with ChappelWood Financial Services. And on today's menu, we're going to be serving up the market doesn't care about the economy. Okay, and so I'm going to explain to you what I mean by this. It's been very interesting, hasn't it? You've been watching the fact that the market really since April has started just keep on going up, 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 up. Meanwhile, the economy has bottomed out to the point that it was the worst quarter that we've ever seen. The second quarter of 2020 was the absolute worst quarter, economically speaking, that we've ever had in United States history. So what gives? Why does the market continue to do this while the economy continues to do that? So let's dive into this, shall we? So let me make sure, there we go. All right. So the stock market, number one. So we're going to go through three key reasons why the market does not care about the economy. The stock market is not the economy, for one thing. That's the first thing you need to understand. There is this belief that the market and the economy are synonymous. And sometimes when you hear the news, they talk about the market and the economy as though they are both the same thing, but they are not the same thing. The economy is backward looking. Okay, the economy measures what already happened. That's why we don't get the second quarter economic numbers until the second quarter is over, right? But the market is forward looking. What do we think is going to happen? That's how people invest. People invest based on what they believe is going to happen. That's how we as financial advisors help our clients. We don't invest based on what has already happened in the past. We might use the past and look at trends to inform what might happen, okay? Trend analysis does have a place, but past performance is not indicative of future results, right? So we have to look at other things, all right? The market is forward looking, and right now, obviously, a lot of people are very excited about the direction of the market. So everyone knew that the economy was going to have a terrible second quarter. It was obvious. The entire economy was shut down. There was I was just on a conference call earlier with one of our strategists, JP Morgan, and they showed a chart and they showed retail, okay, or restaurants actually. They pulled out restaurants from the entire retail sector. And I have never seen this before in any economic report. Never have I seen a decline of 100%, 100% decline in output from the restaurant sector because they were all shut down. Nobody living today has ever seen that happen. So we knew that the second quarter was going to be terrible. In fact, that's exactly what happened. So when the numbers came out in July, late last month, found out that the economy was down 33%. All right. Now, one point that I want to make about that number, when you hear the economic report, the economy was down or up or whatever, a lot of people don't realize that that number is being reported as an annualized number. All right. The economy was not down 33% in the second quarter alone. What happens is that number is reported annualized. So what it did was it took a look at, okay, what happened in the first quarter? Well, the economy was down about 5% in the first quarter, all right? Then they take a look, well, what happened in the second quarter? Well, the economy was actually down a little over 9% in the second quarter. But what they do is they extrapolate that out and say, okay, well, we're going to assume that the economy would be down 9% in the third quarter and 9% in the fourth quarter. So that's 3/4 of 9%. That's 27% plus the 5 from the first quarter gives you 32. No, it was actually about close to 33%. Does that make sense? So you need to understand when you hear those economic numbers, those are being reported on an annualized basis. It does not mean that right now the economy is down 33%. It means if the year ended and every quarter was the same, the economy would be down about 33%. But the other point that I want to make here is that the market continued upward due primarily to rising consumer sentiment. There's hopes that we're going to find a vaccine. I mean, quite honestly, I believe the market is pricing in the fact that we're going to have a vaccine soon. I don't believe the market is right. I think the market is a little ahead of itself right now, believing that we're going to get a vaccine in this calendar year. It is true, there are a lot of pharmaceutical companies right now, very smart people around the globe that are working on this problem. But I believe that it is extremely optimistic to believe that we're going to have a vaccine by the end of 2020. Honestly, it looks more like it's going to be 2021. So the market is kind of pricing some of that in as though it's going to happen this year. But there's also the belief that the economy is going to recover in the third quarter, and it is going to recover, and it's going to recover pretty strongly. Right now, we're projecting for the third quarter, assuming we don't have another shutdown, and that we kind of even out that curve and we start to see a dip in the number of new cases. We've already seen a dip in the number of deaths. And that's one of the key numbers in the virus that people are looking at, is the number of new cases as well as the number of new deaths relative to those cases. And the number of deaths has gone down significantly. We've started to see it topping out of the number of new cases. And assuming we can avoid another shutdown in the third quarter, we are projecting about a 20% increase in economic output for the third quarter and about another 5% for the fourth quarter. So what that would mean is we would have pretty decent recovery by the end of this year. And then, of course, that would be continuing in the next year. But the market has not cared about the economic downturn one bit. The second reason why the market hasn't really cared about the economy: not all industries matter to the market. Not every industry is treated equally when it comes to the market. This may shock you. The 30 most economically damaged industries as a result of the virus could be delisted. Those stocks could be completely delisted from the S&P 500 today, and it would still only shave off about 2 to 3 percentage points of the return of the S&P 500. Okay, so what kind of industries are we talking about that have been hard hit? Well, the travel industry, certainly, airlines, cruise lines, railroad lines, anything that has to do with travel and tourism, been hammered. The restaurant industry has been hammered. Entertainment, movie theaters have been hammered, okay? Those kinds of industries have been hammered. But the hardest hit industries are also the smallest weighted ones in market indices like the S&P 500. So when you hear that the S&P 500 or the Dow was up, specifically the S&P 500, there's this disconnect. People are like, wait a second, the economy is in the toilet. How is it possible that the S&P 500 continues to go up? Well, there are a couple of things at play here. And you need to understand exactly what is being measured in the S&P 500. And this is precisely the reason why I encourage you, don't use the S&P 500 as your measurement for what the market is really doing, or what the companies inside that index are doing, because it's not all evenly weighted. Check this out. Here's what the S&P 500 really looks like. In 2020, up to now, there are six stocks, and we call them FANMAG, okay? So FANMAG: Facebook, Amazon, Netflix, Microsoft, Apple, and Google. Those 6 stocks, so the FANMAG stocks, those are up 37% by themselves this year, okay? 6%, or 6 stocks out of 500. The other 494 stocks in the S&P 500 collectively are down more than 10%. All right? So you've got 6 stocks that are carrying the water for everybody. That's what's boosting up the S&P 500. And take a look there. What one thing do those stocks all have in common? They belong to the technology sector. Technology has been off the charts this year. Healthcare has been off the charts. The most visible industries that you hear about in the news and everybody talks about it, and you walk out your door, you can see the shop across the street. You hear about, home sales are down. People aren't going out to eat. People aren't going to see movies. Retail, travel, real estate, restaurants, entertainment. All of those sectors combined account for less than 3% of the total market capitalization of the S&P 500. And that's the thing that you need to understand about indices. When you see them reported in the news, they're not driven by the individual stocks themselves. What drives the S&P 500 is market capitalization and how heavily weighted towards those different industries is that index. There are 4 industries inside the S&P 500 right now: internet content, software infrastructure, consumer electronics, internet retailers. Those 4 industries by themselves account for 25% of US market capitalization. The entire economy, the entire market, those 4 industries account for 1/4 of all the capitalization, meaning how much money is actually out there. They are the ones that are sucking up all the investment dollars, or a good portion of those investment dollars. Yet, meanwhile, retail, travel, real estate, restaurants, entertainment, all those, you could throw airlines in there, hotels, things like that. All of those industries that everybody's paying a lot of attention to, and it's getting reported, less than 3% of the total market capitalization. If you were to weight the S&P 500, all 500 stocks, weight them evenly with market capitalization and factoring them, the entire index would have been down 10.7% through June 30th. Okay, so that's why you have a situation where the market continues to go up while the economy continues to go down, because the index, the market, is more heavily weighted towards industries which have been thriving, as opposed to those industries which have really been hammered as a result of the virus. Okay. Number 3, here's another reason why the market just does not care about the economy. Reality is not matching with experience. The reality is we've seen job losses. People have taken reductions in their income, reductions in their hours worked. People have seen forced layoffs. We've seen bankruptcies of major mega companies, retailers that have been around for 100 years. You're looking at American Airlines right now, which is giving people early retirement options because they're afraid they might have to declare bankruptcy next year. American Airlines may declare bankruptcy. Okay? So people have seen their own personal situations decline. However, if they have an IRA, they have a 401k, 403b, a TSP, whatever it is, they've seen their investments continue to go up. There's this disconnect again, mentally. One thing is happening to me personally, yet the rest of the world seems to be getting rich. What is going on? The impression then is that the economy has no impact on the market. Now, that's not entirely true. Okay, the economy absolutely does impact the market, but the market is primarily impacted by emotion and what we believe is going to happen. And if we believe that a vaccine is on the way, if we believe that things are a lot better, things are getting better, we're going to invest that way. And we're going to put our money where we believe the market's going to go, not where the economy has already been. All right. So the economy that many people are experiencing right now, it is bleak. It's very personal for them. And for the most part, these people are feeling it. But the reality is, for the stock market, and again, I'm not trying to trivialize what has happened to you or anyone else. I'm simply telling you logically what happens with the market. Okay? The market does not care about you or me or any one person. Your personal situation is either not publicly traded or only plays a very small part in the overall stock market's moves. The movement of the market is based on capitalization. And as long as the largest industries continue to do well, technology, healthcare, things like that, then the market will continue to perform reasonably well. That's not to say that we don't expect some more hiccups here in the third quarter, certainly as we get closer to the presidential election. But that's why you've seen the market continue to go up, because it is weighted more towards industries that continue to do well. And for the most part, the market does not care about your personal economy or mine or anybody else's. It's about how do we feel collectively as a group. So I want to take a brief moment now to just relax for a second and invite any questions that you might have. So if you've got a question that you'd like to ask, The easy way to do that is to go down to the bottom. You see your little toolbar there, and you see a little Q&A box. You can click that box right there, and you can ask any question you want. It doesn't have to be just about the market. It can be about your portfolio. You want to talk about the election? Okay, I'll tell you what we think about the election and what we believe is most likely to happen depending upon who wins. You know, we have got a series of conference calls that we've had this week with many of our investment strategists. And, you know, all of them have something a little different to say, but the one commonality that we keep hearing is that if Donald Trump wins the election, then most likely the market will like that. And it's not because the market particularly cares about Donald Trump. It's because the market likes status quo, right? So as much as things get politicized here, when it comes to the market and it comes to your money, I really encourage you, don't necessarily think with your own heart politically. Think logically about what does the market like politically. And the market likes sane, status quo, no change in party. So if Donald Trump wins, that's kind of the best case scenario for the market to continue going up. If Joe Biden were to win, well, that's kind of the worst case scenario, again, for the market. I'm not making any political statements about either one of those guys. The market will likely react negatively if Joe Biden wins. Then you can throw in, you know, okay, well, people might send it further down because there's a fear that taxes are going to go up and things like that. Well, keep in mind that in order for Joe Biden or any Democratic president, I don't care who it is, to be able to get taxes raised considerably, they can't just sign an executive order and do that arbitrarily. They still have to have Congress, all right? Now, right now, if you were to poll a lot of people, they'd say there's a really strong chance that the Democrats are going to have a clean sweep. The presidency, the Senate, and the House. I don't know how real that is. It's still too early to tell, all right? Now, historically speaking, Republican administrations have been friendlier to the market than Democratic administrations. And the reason for that is that typically under Republicans, they're more pro-business, friendlier business climate, lower taxes, less regulation, things like that. And when companies have to pay less in taxes and they don't have to jump through as many regulatory hoops, what do they have? More profit. More profit translates into higher dividends, higher stock prices, the market goes up. Democrats, on the other hand, tend to be more tax, okay? Tend to be more government spending, all right? And as a result, you tend to see a less favorable business climate. Again, those are general statements based upon historical trends. Do we have any questions from anybody? I don't see anything right now. Let's see. We've got here just a few minutes. So if you have a question, please click on the Q&A button there, and I'm happy to answer your question. Another question that we're getting a lot right now is, what do we expect to happen with inflation and things like that? Because what's happening right now, the Federal Reserve is out buying every asset they can find to try to support the economy and the market. We saw the federal government approve trillions of dollars, almost $3 trillion in stimulus as part of the CARES Act. And so what you're seeing is the Federal Reserve and the government just printing money like crazy, okay? Well, there's a fear that inflation is going to go up. It's going to skyrocket. Inflation could go up, okay? It could. But it doesn't happen that quickly, all right? Because what you have to understand is inflation isn't just about money being printed, the devaluing of the dollar. It's about consumption. 70% of the United States economy is dependent upon consumption, us buying products and services. Even while the economy continues to open up little by little, we're still not spending as much. Okay, we're still not going out to eat as much. We're not going to movies. We're not traveling. We're not doing a lot of those things. So consumption is still down. I'm going to pause for a moment and answer a question. So Denise asks a great question. Is it safer to switch investments to bonds instead of stocks? That's a really great question, Denise. And it's great because the answer is, well, it kind of depends on what you are trying to accomplish. Here's the issue that we're having with bonds right now. And so the simple answer is typically yes. When the stock market is going crazy, people typically run to bonds, right? That's usually where people put their money because they're relatively less volatile and they produce income in the form of bond payments. Here's the problem though. Interest rates are in the toilet. Interest rates are so low that bonds are really unattractive right now. That's why you are seeing gold prices go through the roof. People are scared of the volatility in the stock market. They're looking at bonds like, oh my God, I can't get any money out of that. So what do? They go to the one asset that they believe is going to hold its value. Okay. So they buy gold, and as a result, you're seeing gold prices go up. If you are overly balanced in stocks right now, and let's say you're 80-90% stocks, and it's just causing you heartburn, and you want to lower your exposure to stocks simply because that's how you feel, then sure, you can put in a little bit more allocation to bonds. But just understand right now, because interest rates are low, bond prices are really high. So it could be really difficult to switch from stocks to bonds. And you also have to be cognizant of which stocks are you going to be selling off. Are you going to be selling off losers and locking in a loss and then taking that money and going buying a bond which is overpriced? Right now, I would say that we still feel better about stocks. Okay, we feel better about equities at this point as it relates to the potential for growth and gain. Now, if you have a bond portfolio that is designed to generate income for you, keep in mind when interest rates go down, your interest rate does not go down. It's the interest rate for every new bond. But if you got a bond at 6%, it's going to stay at 6%. What's going to change is the value of that underlying bond. So if you have a bond portfolio that is generating a decent amount of income for you because you're retired and you're depending upon that, I wouldn't change that. All right. Just like I wouldn't change your stock portfolio simply based on what's happened right now in the market. This is a temporary fluctuation. And if you say to yourself, you know what, I was comfortable with a 10% decline in my portfolio before this, I'm still comfortable with a 10% decline, I wouldn't necessarily go out and sell off all your stocks based on this one thing. Okay, there needs to be a bigger reason to sell off your stock portfolio than just I'm scared of what's happening right now. Because as we've already seen, from the low point in the market in March, the market is up almost 45%. Okay, it's shocking to think the S&P 500 is actually positive for the year. But of course, as we've seen, a lot of that is due to those 6 stocks. So Denise, I would say if you're going to switch from stocks to bonds, I want to make sure that there's a good reason for it. If you personally want to take on less risk, that's fine. But if it's, oh, I'm afraid I want to kind of bounce in and out of the market, I'd be very cautious about that because your stock portfolio should have recovered pretty well over the last few months. But if it's in response to a fundamental shift in your appetite for risk, absolutely. We should take a look at how are you balanced? Where would you like to be? What would make you feel a little bit more comfortable? And then what are you trying to accomplish with the stock side and the bond side of your portfolio? Okay. So thank you for that question. Let's see, we have any other questions? We've got just about 5 more minutes here for our lunchtime drive-through. I hope you're enjoying your day. Hope you're enjoying your lunch. I do want to take just a little bit of time to talk about another topic that is top of mind right now, and that is energy. Many of you on the call today have investments in energy. You work for an energy company, an oil company, what have you. And again, being in Oklahoma, where I'm based, many of our clients are based. I know some of you are not in Oklahoma, you're out of state. And thank you for watching. If you derive a lot of the income for your retirement or in your portfolio from oil, you should expect oil prices to stay kind of where they are for right now. We don't really see oil going up over $50 a barrel anytime soon. And it's really due to global demand. Demand is way down. And so long as we have this virus that is preventing people from traveling as much and moving around, there's not going to be as much of a demand for oil. And as a result, the prices are going to be down. Let's see, we did have a comment that came in here. I'm going to take. Oh, okay. You're very welcome, Denise. Very happy to answer that question. So Oil prices, unfortunately, are probably going to stay low for a while, at least kind of in that 40 to 50 range. And typically what we see is oil producers typically like to see that price at least around $60 a barrel in order to kind of break even, or, to make things run a little more smoothly. So we're probably going to run a little cold for a while on oil prices. So if you are, again, depending upon oil to generate some of your income, you may want, and up till now, you've not been taking any income out of your investment portfolio, and it's been more of an accumulation focus. I know we've got some people here on the call today that we're getting ready to shift their portfolio from growth to income because they're getting ready to retire. So if you're seeing a reduction in your oil revenue, you're seeing a reduction in your rental income, if you own real estate, business, whatever it might be, that's a really good time to say, okay, let's maybe shift your portfolio from growth to an income focus. And what do we mean by that? Well, we shift from growth stocks to more dividend paying stocks. That, Denise, would be a good reason to maybe increase your bond exposure because you want to increase income, high yield bonds, things like that. So keep that in mind. I want to let you know that I don't have any other questions right now, and I will answer any questions that come in. But if you want to learn more, I'm glad that you were here today, and we're always going to talk about little things like this next or on our Wednesday lunchtime drive-thru. But if you want more, you want to get a little bit more in depth in some of these conversations about how not to run out of money, Social Security, Medicare, tax efficiency, estate planning, I want to invite you to enroll in my Rocky Retirement course. It's 4 hours of education over 2 nights, and it's totally online, and we're going to do it free for the rest of this year. Typically, we charge $50 for it, but we have had such an outpouring of people saying, hey, man, I really want to come to your class, but I lost my job. I mean, $50 matters, right? I mean, that's a tank of gas. That's being able to pay my water bill, something like that. So many of you have lost a job. You've got questions about what should I do with a 401k rollover. I need to transition from growth to now income and preservation. How do I do that? So we're going to cover the 5 key areas of retirement planning that you need to know in that class. We provide the course workbook to you. The next class is starting next Thursday. So the August session starts August 20th. So they're both Thursday evening. Session 1 is August 20th. Session 2 is August 27th from 6:30 to 8:30 p.m. To get enrolled, all you got to do, and you should be able to click that link right there, ChappelWoodU.com. When you click that link, it's going to take you to a page that is going to look something like, here, let me share my screen here, and I'm going to show you what this looks like if I can find it. It's going to look like this. So when you go to that page, you're going to click the enroll, and you're going to see this. And what you want to do is click the 20th right there. You click 6:30, confirm, and then it's going to ask you a few questions, okay? We ask you just to fill in a few little questions, a little information. Why are you wanting to come to this class? What's motivating you? What questions do you have? What are your concerns? That sort of thing. Fill out that information. Tell us how you heard about it. Hit schedule the event, and then you're enrolled. You're going to get a notification email confirming your enrollment in the class, and I will be sending to you the workbook, and then, of course, you'll get the link to join the class here online, and the class will be a Zoom meeting just like this today. So I want to thank you so much. Just last call for any questions. If anybody has any questions, go ahead and get enrolled for Rocky Retirement. I'm going to go ahead and bring back up the page where you can enroll. Let me come back over here. There you go. So again, click that link right there. You should be able to do that. And if you can't, if for some reason you're not able to get enrolled, give us a call at 348-0909. Shelly will be happy to get you enrolled over the phone. You can also email me. My email address is Damon, D-A-M-O-N, @ChappelWood.com. You see ChappelWood down at the bottom of the screen there. That's how you spell it. And send me an email, and I'm happy to answer any question that you might have, get you enrolled in the class. And, I want you to be informed. That's the best way. Knowledge, education, that's how you make good retirement planning decisions. So it is 12:30. Our lunchtime is over. I hope you enjoyed it. Thanks so much for eating with us today. And we'll see you next week. Just a teaser, next week, on the lunchtime drive-through, I'm going to be covering 20 questions that you should be asking right now about the market and your retirement and the economy. Okay, so 20 questions. We're going to go rapid fire. You're like, 20 questions in 30 minutes? Yes, 20 questions in 30 minutes. That's what we're going to talk about next week. So hope to see you next week. Thanks so much for watching. Oh, we got one more comment coming in here. Oh, thanks a lot, Linda. Glad you enjoyed that. I hope I'll see you on the call here in just a little bit, in about 30 minutes. Hopefully I'll see you there. I know many of you are going to be joining us on another conference call here at 1 o'clock. So thanks again, and we'll see you next time on the Wednesday Lunchtime Drive-Thru. Take care.